Good morning and welcome to the Saxo Bank Morning Call. It's Friday, October 5th. It's U.S. Jobs Day, and we have quite a lot going on this week. The big move in U.S. interest rates, I think, really dominates the picture. That big move in the 10-year above the 3 and spot 12% rate, and then the 30-year this week, the really big one, first 4-year high above 3.25%, the first 4-year high in U.S. 30 years since 1981. And Steen, you have some thoughts on where, first of all, what's driving this, and also where could we be headed with these U.S. rates?
So I think Jay Powell really caught the market off guard on Tuesday with his speech, where he pretty much says we only just started on the normalization process in U.S. interest rates.
Far from neutral, I think.
Far from neutral, exactly being the wording. Yeah. And I think to some extent people are starting to realize this is a Federal Reserve who is ignoring totally what goes on in the rest of the world, which, by the way, is a classic way of operating from the Federal Reserve overall. So there is some nervousness, and we see some escalation in terms of the actual speed at which these rates are going up. And as we can show in the chart, charts are always very easy to manipulate, but to some extent, if you look from a technical level, as we try to indicate here, the 61.8% retracement would equate to exactly 400 basis points. I think it's pretty certain that we will see 360, 365. 400 is a reach because, of course, there is the collateral damage to the rest of them.
Also pretty reasonable because a lot of these longer yields you're often seeing clustering around the big round levels.
Absolutely.
3%, 4%, 3.5%.
We saw it in 10 years. 3% was sort of an obstacle for a long time. But ultimately what will drive this is a combination of and we remain of the point that the reason why Federal Reserve gets away with, to some extent, doing these hikes is that there is such a rich liquidity in the domestic U.S. market, whereas the rest of the global market in terms of funding is very, very short.
Yeah, and classically these big rises in long interest rates consider to put some pressure on equity prices because equities, after all, is sort of a long duration instrument, if you will. The classic example being 1987, where we saw the big run-up in interest rates and then the crash later in the year. I'm not talking about a crash now, but finally, it seems yesterday, pretty ugly session in Wall Street. Is this linked to the interest rate picture?
I think it's part of the explanation. I think there's two forces driving the market reaction yesterday, and which, by the way, was the strongest in U.S. technology stocks, down around 2.3% in the NASDAQ 100 index futures. I have that on the chart here. So pretty ugly session. We're still firmly above those support levels from earlier in September. You can see around the 7400 level here. But I think there's two drivers. It was China. There's a story that the Chinese intelligence service have planted small microchips onto U.S. server chips that was then sold into companies like Amazon and Apple. Amazon and Apple went out actually and refuted the whole
of
thing.
Course.
Yeah, of course.
Yeah.
But nevertheless, there was a lot of nervousness, and Supermicro, which is the company that is the center of this whole thing, is sunk by 50%. But I think the interest rate is more important. And as you know, I've been arguing many times on this program that the technology stocks, they have very little debt, so they have very little interest rate sensitivity. But as you say, I thought about it yesterday, it's a very long duration asset class. So when you have the discount rate on these future cash flows going up, it has to take the growth stocks, the ones with the highest valuation, has to go down the most. And I think that's what we're seeing right now. I think we should be super cautious on U.S. equities at this point in time.
And as well, Peter, we had, of course, a story about this chip, but we also had a speech from a vice president in the U.S. where he's singling out Google for its policy of developing the so-called Dragonfly app. And Steen, we saw this speech yesterday. Both you and I watched it. This is pretty scary stuff to me. The market reacting maybe a little bit to the China story from a couple of angles here, but this is a huge showdown between the U.S. and China.
And it is an extension of the sort of scenario that we're saying all along. This is a trade war that is for real. I would probably even go to the length now to call it a new Cold War. Of course, the Cold War was more militarily, now is a technology war. Don't forget the 2025 plan by China is seen by the U.S. as a technology challenge to the U.S. And likewise, U.S., of course, with the speech from Pence yesterday, made it absolutely clear that, and he re-mentioned the fact that the strategic enemy is China, the military enemy is China. Russia is not even in there. It gives you a indication of the scope at which this is going on. And coming into the midterm elections, should he lose some sort of footstep in terms of his ability to navigate the domestic agenda, I think he's only going to push the rhetoric even stronger against China And what's interesting in the U.S. is it resonates both with the GOP and the Democratic voters. So there is a uniform backing for this policy. Is it conductive to the market and the overall market? Absolutely not. And I would say, and you know, I did an internal note a couple of days ago, that I think personally this is one of the worst time in the 30 years I've been doing this job. And I'm more nervous now than I've been ever, because you have this extremely complex system. And on top of that complex system, the political system is totally unable to talk to each other even.
Right. And of course, that whole theme underlined by these a lot of these trade deals being wrapped up with some of the closer U.S. partners, Mexico, Canada, and the focus being more squarely on China. There's this sort of, I think, naive headline that maybe they can strike some kind of quick deal with China, but it doesn't look like the cards are.
No, if anything,
because of the serious geopolitical issues and tensions economically. Yeah.
If anything, I think they're closing down those sort of negotiations to be able to actually focus on the China issue, because you cannot have the U.S. trade negotiations being involved in 5 different negotiations at the same time. They need to focus the endeavor on, containing China, and China is interpreted this as a containment of them, and hence this becomes almost a Mexican standoff.
And despite all this risk, we have, of course, the ongoing stimulus going into the U.S. economy from Trump's tax cuts and so on. Those rates continue to climb. Also at the short end, you've got some valuation perspective here on where we are at stocks versus the 3-month yield. I mean, we have this vertical climb, or very steady 45-degree angle, at least on the chart, climb in blue. That's the U.S. 3-month T-bill yield. And of course, with stocks going higher and higher, even though earnings have been growing, the dividend yield is actually quite low.
Yeah, and this is sort of an argument we somewhat borrowed from Gunderlag from Double Line. And the argument here, of course, is that right now, last year at least, you could still argue the U.S. stocks was cheap because the alternative, the fixed income market, was not really giving you any comfortability. But if you bring the chart up again here, what we're trying to indicate is that, of course, the spread between the two has to be significant to actually make a difference. And what we're seeing right now, and what we assume, is that if you can have 3 months' money deposited at 2.3%. Against a yield of 1.8, you really have to have a good reason why you own the stock market, and increasingly you, through the Fed action, are allowing the U.S. market to normalize, not only just in the policy rates, but also in the ability of fund managers, pensioners and savers to actually use the deposits as a alternative to risk. So to some extent, the U.S. system is trying to de-risk, which I presume Peter would also argue is
cash in a way competing for
cash. Cash is all of a sudden an asset class again. It disappeared since the great financial crisis. Now in the U.S. is coming back, and maybe it even translates into a global increase in interest rates on the back of the inflationary aspect that we see right now from energy.
And Peter, on the subject of valuation increases, and we've talked about the overvalued U.S. market potentially, but you're seeing global equities worldwide picking up.
Yeah, but just very quickly as a side note to Steen, I mean, which we talked about before we went into the show. I mean, if you look at the 15-year mortgage rate in the U.S., it's at 420-ish basis points, and so why would you buy a perpetually cash flow in equities with a potentially a 50% downside in a severe recession versus a mortgage in the U.S. where you can lock in 4.2% and then have a much better downside risk profile. So I think the risk-reward ratio in U.S. equities is getting very ugly. But coming back to the chart I brought with you today, I'm going into the helicopter perspectives because I've been away for a couple of weeks here. But you can see here valuations on global equities, at least measured across an average of 9 valuation metrics, is climbing again. We're getting back to that highs from January. Still not overly above the average since 1995, but we are moving into the positive territory, and that for each point we climb higher here, the expected return going forward will be lower. And if you take the next chart, I sort of plotted in the 10-year annualized return in this period, 1995 to 2008. We cannot use more data because we cannot go further back. We don't have data before 95. And the red line here is where we are in terms of valuation. So you can see in nominal terms, we have this range between 4% and 8%. But I would think that my interpretation of this is actually that the U.S. equity market, because it's so overvalued right now, is probably inflating these numbers a little bit. I think the nominal expected return from current valuations is probably closer to 4. And if you discount the inflation, I think if you buy into the equity market today, globally, I think you're probably looking at a real return that is closer to 0.5 to 1%. So I think Steen says, I think you should begin rotating, or at least reducing exposure in equities, and particularly in U.S. equities. I cannot stress that enough. I put it out on home.saxo. Really think about it and get probably out of the growth stocks more and more.
Okay.
Yeah.
And now in terms of Forex, I think the most interesting question here with this rise in yields is the Japanese yen. We have this very awkward policy, almost sort of a peg-like situation. We've talked about this a lot recently. The Bank of Japan's yield curve control policy, fixing the 2 to 10-year yields. And we have a chart here of that 10-year yield. It is a weekly one to get the longer-term perspective here, but there's been an awful lot of action here in the last week as we've hit that 15 basis point cap, which the Bank of Japan sort of tweaked policy by putting that cap a little bit higher. The longer end of the Japanese government bonds yield curve actually being allowed to sort of course, track global bond yields. But the implications are, if the Bank of Japan doubles down, the pressure goes into the currency. If we have a sense, I think, even if rates are rising, generally that's a yen negative, but if rates are rising and risk appetite is wobbly, concerned about that, and we have the Bank of Japan wobbling in its commitment, I think it's a very powerful force in favor of yen volatility and potentially yen upside. And I have a couple of perspectives on that. We have the dollar yen at this key 114.50 area. That was the big high of the range back for most of 2017. 115, I would argue, is a bit more of a psychological level. But importantly, even if we don't know what's going to happen, just the potential scenarios out there argue for tremendous potential for yen volatility, and we have longer term dollar yen volatility implied in the options market at low of the low of the multi-year range, and that low back in 2014, by the way, we're talking about all-time historical lows. So these are very low levels. Tucking away some yen volatility is one answer to all of this. Looking for at some point this higher yield pressure resulting in some sort of mishap or at least volatility event across markets. And then I think we'll round out today's. Actually, I'll briefly mention Sterling Aussie. We've got a chart here. Interesting themes going on. We have some new Brexit hopes coming on board. Donald Tusk making some interesting overtures on a Canada triple plus apparently deal, and as well Aussie being dragged down by fears on what this will mean for China. The latest U.S.-China slowdown. So Sterling Aussie at a quite interesting inflection point. This is a weekly chart, so that's going back a couple of years. If we close near these levels or higher, a breakout signal there. Quite interesting. And then on the calendar, it is a U.S. jobs day. The key point here, I think, above all others for today specifically, that average hourly earnings number. We had the 2.9% year-on-year print the last time around. This was the high for the cycle. They're expecting it to nudge back to 2.8%. That's a bit of a uninteresting development. If we're at 3%, I think we get the bond market in focus again already today rather than maybe next week. So watch for that, and also watch for the U.S. CPI next week. And if you're an emerging market trader, watch out for the Brazilian real. We have that election first round this weekend. I've got a chart here of the dollar Brazil. It's really been on fire, the Brazilian real, despite the tremendous uncertainty linked with this election. You've got a left populist fighting out with a right populist. Will this mean any kind of fiscal responsibility from whatever comes out the other side? I have my doubts, but we have a pretty interesting technical development in dollar Brazil breaking down despite those stronger U.S. yields and a pretty firm U.S. dollar. That's it for today, and we'll be back next week. This is Friday, so have a great weekend out there. We'll be back next week with the Saxo Bank Morning Call.